Okay, future CPAs, let's get real about one of the topics that loves to trip people up, trading securities. But we're not just going to go over the rules. No, we are going to build a system to lock this stuff into your brain for the next 3 years, so it's still there when you're sitting for the board exams. You know how it goes, right? You spend hours, maybe days, on financial assets. You feel like, okay, I got this. And then, come exam time, the specific rules for FVTPL just, poof, they're gone. It's a super common problem, but we're about to fix that for good.
So that's what this is all about. We are literally going to build a memory palace for this topic, a mental framework that makes these rules feel less like stuff you have to memorize and more like stuff you just know, intuitively. Let's get into it.
First things first, we got to face the challenge head on, and that challenge is fair value through profit or loss securities, or FVTPL. You're going to see these on the exam, so getting them right is, well, it's not optional.
Now, to make this stuff actually stick, we need to give it a personality. So from now on, I want you to think of a trading security as the day trader of a company's investment portfolio. Its whole vibe is about making quick moves for quick profits.
And look, the official definition backs this up completely. The key phrase to burn into your memory is short-term fluctuations in price. It's all about buying and selling fast to catch those market swings. That's the name of the game. And this right here, this is absolutely crucial. When you're staring at an exam question, the very first thing you need to figure out is the intent. Why did the company buy this security? Was it for a quick flip? That's FVTPL. Or was it a more strategic, long-term thing? Then you're in a different ballpark. Intent determines everything.
Okay, so once you've identified a security as FVTPL, a very specific, very rigid set of rules gets triggered. We're going to call them the 3 golden rules. You need to know these cold.
Golden rule number 1. It's nice and simple. The moment a company buys a trading security, you put it on the books at its fair value. You know, basically what they paid for it. No funny business. And hey, don't just take my word for it. The standard says it right here. The acquisition cost is the fair value. So no complex math needed. It's just the transaction price. Clean, simple, let's move on. Now for golden rule number 2, and please listen up because this is a classic LACPA trap. All those little costs to buy the security, like brokerage fees and commissions, for trading securities, you expense them immediately. They do not get added to the investment's cost. The rule is absolute, recognized outright as an expense. This is a huge deal because for other investments, you might capitalize those costs, but not for our day trader securities. Nope, it's an immediate hit to the income statement. And here it is, our third and final golden rule. This is the big one. At the end of every single accounting period, you have to adjust the investment to its new current fair value. Any change, whether it's a gain or a loss, goes straight to the income statement, straight into profit or loss.
Let's just walk through this real quick. The company buys stock for 100 grand. By the end of the year, it's worth 120,000. That 20,000 peso jump is an unrealized gain that boosts that year's profit. But then the next year, the stock's value falls to 95,000. So you compare it to the last value, the 120K, and that's a 25,000 peso drop. That becomes an unrealized loss on the income statement. It directly shows the market's mood swings in your financials.
So we've got the rules. Now let's make them stick like glue. This is where we actually build that 3-year memory palace. Here are your brain hacks. First, the name literally gives away the biggest secret. FVTPL. It tells you that all the changes go to profit or loss. It's right there. Second, for transaction costs, just think of them as annoying little admin fees for making a quick trade. They're not part of the investment's real value. They're just a cost of doing business in that period. And finally, always go back to our day trader. A day trader calculates their wins and losses every day. A company does the same with its trading securities every reporting period. Okay, we've built the foundation. Now let's boil this all down into one super powerful slide. Seriously, get ready to screenshot this. This is your go-to review sheet. Let's lock this in one last time. The intent, short-term profit. Initial measurement, fair value. Transaction costs, expense them immediately. Subsequent measurement, back to fair value. And the unrealized gains or losses, they go straight to profit or loss. That is the entire life story of a trading security. You got this. And there you have it, the 3 golden rules, the brain hacks to make them stick. You didn't just review this for a quiz. You've installed a permanent file in your brain for the LACPA. So now the only question is,
What topic are you going to master next?